All right, joining us on the line today is Steve Harbeck. He is the president and CEO of the SIPC. That is the Securities Investor Protection Corporation. Steve, thanks so much for taking time to join us on Follow the Money Radio.
You're very welcome. Glad to be here.
We get a lot of questions here many times about brokerage accounts. You know, when a brokerage firm is closed for some reason, many people think immediately of FDIC. So maybe they have some stocks in Merrill Lynch or they have stocks in E-Trade or something. And then suddenly they wake up one day and they find out that the company has just completely imploded due to some bad management or whatever the case might be. And some people think, well, that must be FDIC insured, but it's not FDIC, it's actually SIPC. Can you explain how that works?
Yes, I can, and there are some very important differences. The main thing that we protect is the custody function that brokerage firms perform for their customers. It is our job within statutory limits to get you back the contents of your securities account. The major difference, and this is very difficult for some retail investors to understand, is we don't guarantee you that your securities will be worth what you paid for them. They could go up, they could go down. SIPC is market neutral. Our job is to get you back your portfolio to get you the benefit of your bargain, whether it was a good bargain or whether it was a bad one.
That makes total sense. So we think about places like Lehman Brothers or we think about MF Global. In those situations, did you pay out to those people who were involved?
Well, oddly enough, the two cases that you've just mentioned were liquidated under the Securities Investor Protection Act that SIPC administers. In those instances, because the trustees made recoveries, it wasn't necessary for SIPC to make advances, but had there been any missing securities or missing cash from customer accounts, we would have restored those customer accounts with an additional $500,000 worth of securities over and above each customer's share of the assets that were located.
Okay, so that is important. So you have a $500,000 limit in stocks, bonds, any kind of securities.
Correct, and there's and the limit on the amount of cash that we can return to that we can advance for any customer is $250,000. Again, though, that's on top of everybody's share of the customer property that the trustee actually has. The best example I can give you is if 10% of all customer property is missing, that means necessarily 90% of everything that customers are supposed to have is there. That means each customer would get 90% of his or her account back, plus up to an additional $500,000 worth of securities advanced from SIPC to make the account 100% whole.
Now, when you say securities, let's define that real quickly. We're talking about stocks, bonds, CDs. We're talking about even option contracts. What are we not talking about?
Well, we're not talking about limited liability partnerships and private placements. But outside of that, most things that are commonly defined as securities are protected by this statutory program.
What about futures?
Futures are not protected. Actually, the American marketplace developed futures and commodities separate from the securities markets, and we do not protect those unless they're in a combined margin account governed as a securities account.
Got it. Okay, so if somebody has $1 million in, say, E-Trade, and then just God forbid something happens to E-Trade, they get some sort of fraud or whatever, then it behooves that person to have two different $500,000 accounts in order to be protected. Is that how I read this?
Well, that's what I would consider an excess of caution, because let's use your numbers. If you yourself had $1 million securities portfolio at E-Trade, and 50% of all of the securities that E-Trade owed to its customers somehow went missing, each customer would get 50% of his or her claim satisfied from the available 50% that wasn't missing, and up to $500,000 on top of that.
Over and above, I see.
Okay, so in point of fact, taking the Madoff case aside, there's only been 350 people in the 45 years of this corporation's history that haven't been made completely whole by a combination of what the trustee recovers and advances from SIPC. And most of those advances from SIPC, most of those people had their claims at a time when the advance that we could make was considerably lower in dollar amounts.
Wow, very interesting. Okay. So finally, I guess for all of our folks who are listening today, if indeed you do have money in a brokerage firm and it does go down for any, God forbid, reason, don't think of the FDIC. Is that correct?
That's correct. Well, the one thing I would say is that since many sophisticated financial institutions sometimes sweep brokerage cash proceeds into a bank account, then if that is the case, then yes, the FDIC would protect your cash because it would technically be in a bank.
So, but if a person is in that situation, does SIPC just immediately step in and they don't really need to make a phone call to you? Obviously, they just wait.
We're not a regulator. The Securities and Exchange Commission or FINRA would notify us if there were customer assets missing or at risk. We would then go to court to have a trustee appointed, and the trustee would notify everyone listed as a customer of the firm. What we would first attempt to do is do as seamless a transfer of the customer assets as possible. In Lehman Brothers, for example, since you brought it up, when Lehman Brothers failed, we transferred $92 billion worth of securities to 110,000 customers in the first 2 weeks of the failure of the firm, even before we were able to send out claim forms. We do try to transfer it to a solvent brokerage firm whenever possible.
Makes total sense. When you walk into a bank, you see the FDIC sticker, and then you know that they have FDIC insurance. How do you know whether a brokerage firm has SIPC? Are they all required to, or is it optional?
This is not an optional program. It's required by law. You can go to the SIPC website, which is www.sipc.org, and look at the list of our current members and to assure yourself that you are dealing with a SIPC member brokerage firm. It's also important, I might add, to make sure that if you're writing a check to a brokerage firm, that you're writing it to the SIPC member firm rather than any affiliate that the firm might have.
My guest today has been Steve Harbeck. He's the president and CEO of SIPC, that is the Securities Investor Protection Corporation. Steve, thank you for the great information today.
Okay, you're very welcome.